All right, so are you ready to dive in? Let's get right into it. Can you really generate $2,900 a month passively just using ETFs?
Well, that's a great question, and it's the very question that one of our listeners asked us to dive deep into.
Yeah, they even sent us a whole guide that's dedicated to just this.
Yep, a whole roadmap.
So we're going to take a look at that. We're going to see why ETFs are even considered for this, this kind of passive income strategy.
Right.
And we're going to go through different types of ETFs that can generate income.
Absolutely. We'll break it all down.
And, of course, we've got, our ETF expert here with us to help explain everything.
Happy to be here.
All right, so hitting that $2,900 a month consistently, that's the dream, right?
Yeah, it's a good goal.
The guide lays out a path. But it all starts with understanding WHY we're even talking about ETFs.
I am.
For this kind of passive income.
Okay, yeah.
What is it about ETFs that makes them a good choice?
Well, I think what's fascinating about ETFs is they offer this really interesting blend of diversification, low fees, and liquidity.
Yeah. Oh, those are all good things.
Yeah, it's like, in the investment world, having your cake and eating it too, almost.
Right. Okay. Now let's not assume that everyone listening is like an ETF whiz.
Yeah. Good point.
When we say diversification, we're talking about spreading the risk.
Yeah.
Instead of just, betting it all on one single stock.
Absolutely. Think of it like this. If you're investing in a single stock, it's like you're putting all your eggs in one basket.
Yes.
Right.
Yeah.
But with an ETF, you're spreading those eggs across multiple baskets.
Oh, I like that.
Which, if you're actually carrying a dozen eggs, that's much safer.
Yeah, that's a good visual. I was getting nervous about my eggs there for a second.
Exactly.
But seriously.
Yeah.
That really drives the point home.
It does.
Less risk, which is always a good thing, especially when you're talking about income you rely on.
It is, absolutely.
Okay, so ETFs do that. Inherently, they're already diversified.
Yeah, yeah. That's the beauty of them. You're buying a basket of assets with a single purchase, so you don't have to go out and spend hours researching individual stocks.
Yeah.
And trying to diversify your portfolio that way.
It's done for you.
It's done for you.
All right, I like that. Okay, so we talked about diversification. Low fees are obviously always good.
Always good.
But why are they especially important when we're talking about passive income in particular?
Well, I think with passive income, every dollar that you're losing to fees is a dollar that's not working for you.
Right.
It's not generating that passive income stream.
Right.
So ETFs are really attractive.
Yeah.
Because they typically have lower expense ratios compared to, say, mutual funds.
Okay.
So that means you keep more of your returns, and over time, those savings, they can really compound and make a big difference.
So it's not just about reaching that $2,900. It's about keeping it.
Absolutely. It's about efficiency.
Yeah. Okay.
Maximizing returns.
Right. And then the last one there, liquidity. I think that one maybe sounds a little more abstract than the others.
It does. But liquidity essentially refers to how easily you can buy or sell an asset.
Okay.
So with ETFs, you have the flexibility to buy or sell quickly and easily on major stock exchanges, just like individual stocks.
Okay.
So this is a key advantage for income investors because it gives you that freedom to adjust your portfolio or access your funds quickly if your needs change.
So let's say, hypothetical scenario.
Yeah.
You're happily collecting your $2,900 a month.
Right.
But suddenly something happens. You need access to a larger chunk of your investment.
Yeah.
ETFs allow you to do that.
They do, exactly.
Yeah.
You can sell a portion of your ETF holdings without major hassles or delays.
Okay. All right. So that's a good thing to have, that financial agility.
It is. It is.
All right. So ETFs bring diversification to spread risk. They have low fees, so we keep more of our returns. And they have liquidity to give us options. That's a pretty good case right out of the gate. Now let's get down to the big question here.
Yeah.
How much do you actually need to invest to hit that $2,900 a month goal? I'm ready for some numbers.
Okay, let's dive into the math. But remember, these are just starting points.
But?
The actual amount that you'll need depends on several factors, most notably your target yield.
Okay. Yield. So that's essentially how much income an investment generates.
Annually, right, as a percentage of its value.
Exactly.
Okay.
Higher yields mean you need a smaller initial investment to reach your income goal. But of course, higher yields often come with higher risks. It's a classic trade-off.
Right, right. Okay, so the guide lays out this handy formula. Investment needed equals the annual income you want divided by the yield percentage.
Okay.
So since we're aiming for $2,900 a month, that's $34,800 annually. Okay. Let's play with some numbers here. So what if we're aiming for a conservative, say 4% yield?
Okay, so if you're targeting a 4% yield, you would need around $870,000 to generate that $34,800 per year.
Okay, so that's a significant chunk of change.
It is.
What if we bump that yield up to, say, 5%? Okay, so a 5% yield brings the required investment down to $696,000. Still a sizable amount, but notice how just a slight increase in that yield can have a pretty significant impact on that initial investment needed.
Yeah, that's a pretty dramatic difference. Now, what about pushing it further, 6% or even 7%?
Okay, so at a 6% yield, you would need $580,000. And if you could find investments yielding a consistent 7%, if that number drops all the way down to $497,143.
Hold on, wait a minute. So you're saying I might need less money up front if I'm comfortable with more risk?
It is counterintuitive, but
Yeah.
that's the power of yield.
That's kind of crazy.
Yeah, the higher the yield, the less principal you need to generate that desired income. But again, it's important to remember, higher yields often come with higher volatility and the potential for larger price swings.
Right. Okay, so no free lunches
No free lunch.
in the investment world.
Right?
Got it. So finding that sweet spot between the yield that you want and your own personal risk tolerance, that's where things get tricky, right?
That's where it gets interesting.
Yeah. It's about aligning your investment strategy with your individual comfort level and your financial goals.
Right.
And that's where understanding the different types of ETFs that generate income really comes into play.
Right, so this is where we get into the ETF deep dive.
Let's do it.
So the guide here mentions 3 main categories of ETFs: dividend ETFs, REIT ETFs, and bond ETFs.
Okay.
Let's break those down one by one. Let's start with dividend ETFs. Now, those seem to be like the crowd favorite for income investors.
Yeah, they are. They are.
What's the reason for that?
Well, with a dividend ETF, you're essentially becoming a mini landlord.
Okay.
But instead of owning properties,
Yeah.
you own shares in companies that pay out a portion of their profits to
No.
shareholders.
So you're getting a cut of the company's success, but you don't have to deal with like leaky faucets
Exactly.
and like noisy tenants.
Exactly. And you get those payouts regularly, typically quarterly,
Yeah.
which can create a really nice stream of passive income.
The typical yield range for dividend ETFs is roughly 2% to 5%, depending on the specific ETF.
In the sectors that it covers.
All right, so getting a steady stream of income from companies just sharing their profits. I like that. Before we move on to the next ETF type, are there any specific examples in the guide of dividend ETFs?
Absolutely. The guide highlights some popular choices, like the Vanguard High Dividend Yield ETS, ticker symbol VYM,
Okay.
which focuses on large U.S. companies known for their consistent dividend payouts.
Yeah.
And it currently offers a yield of around 3%.
Okay, BYM. Got it. Anything else?
Yeah, there's the SPNER S&P Dividend ETF, ticker symbol SDY.
Okay.
This one targets companies with a long history of increasing their dividends. So you're not just getting a consistent payout, but potentially a growing one over time. And that one also has a yield, currently near 3%.
Okay, so SDY is for the investors who like to see their income grow along with the company.
Yeah, exactly. Exactly.
Any other dividend ETFs worth mentioning?
Yeah, one more. The iShares Select Dividend ETF, ticker symbol DVY.
The BVY. Yeah.
It focuses on established U.S. companies with a history of paying high dividends. And its yield is currently around 4%.
All right, so we've got VYM, SDY, and DVY. 3 solid options for the dividend ETF world, each with their own kind of unique approach. I like that. So now let's move on to the next category, REIT ETFs. Now, I've heard that these can offer some pretty attractive yields.
They can. They can.
Sure.
Yeah, REIT ETFs or real estate investment trust ETFs can be really yield powerhouses.
Okay.
They invest in real estate assets that generate income from rentals and leases.
Okay.
And those rental payments
Yeah.
flow right back to you. As the ETF shareholder,
Okay.
are commonly looking at yield between 4% and 8%, sometimes even higher.
Wow. So
Yeah.
8%, that's significantly higher than those dividend ETFs we were just talking about.
It is.
Higher yields often mean higher risks, right?
That's the trade-off.
Yeah.
And REIT ETFs are no exception.
Okay.
They tend to be more sensitive to economic cycles and interest rate changes.
Okay.
So if the economy takes a downturn, rental income can suffer.
Right. And if interest rates rise, it can become more expensive for REITs to finance their operations, potentially impacting their profitability.
Okay, so potentially lucrative, but maybe a little bit more. of a wild ride.
Yeah, you could say that.
Okay, now the guide mentions a few specific REIT ETFs
Oh,
that kind
that's
of illustrate this range. The first one is the Vanguard Real Estate ETF, ticker symbol VNQ,
Okay.
which is well-diversified
Yeah.
across various real estate sectors
Oh,
and offers a yield of around 3.5%.
It does.
VNQ, noted. What else?
And then we have the Schwab US REIT ETF, ticker symbol SCH.
SCH.
This one focuses specifically on American real estate,
Okay.
and it offers a yield close to 3%.
Okay, so both of those
Okay.
are considered relatively stable options.
Yes, they are.
Okay, but I'm sensing there's a REIT ETF that's on the list that maybe embodies that wild ride you were talking about.
You bet. There's the Global X Super Dividend REIT ETF, ticker symbol SHRET.
Sweat.
Yep, this one is all about chasing those high yields it currently boasts, a potential yield between 6% and 7%.
Whoa. But buckle up, because FRET is known for its volatility.
Okay, so SRET, high yield, high thrill. REIT option.
You got it.
I can already see some listeners getting intrigued. But remember, everyone, before you jump in, do your homework. Understand the risks.
Absolutely.
Right. No investment is a guaranteed win.
Nope.
It's all about aligning your choices with your risk tolerance and your overall goals.
It is.
Okay, so we've got dividend ETFs, REIT ETFs, still one more category to go. Bond ETFs. These
Yeah.
are often seen as kind of the steady Eddie in the investment world, right?
You could say that. You could say that.
So what's going on with bond ETFs?
So bond ETFs invest in bonds,
Yeah.
which are essentially loans to governments or corporations.
Okay.
Those entities pay interest on those loans, and that interest is passed on to you as the ETF shareholder,
Right.
providing a regular income stream.
So with bond ETFs, you're
Yeah.
basically lending money to governments and corporations and getting paid interest in return.
That's a good way to put it.
So it's kind of like
Being
paying
on-
the bank
But on a much smaller scale.
on a much smaller scale.
All right.
And while the yields on bond ETFs might not be as flashy as those offered by REITs, they typically fall in the 2% to 6% range, depending on the types of bonds held in the ETF.
Okay, so respectable yields. But what's the main appeal of bond ETFs?
I think what's fascinating about bond ETFs is their role as a stabilizer. In a diversified portfolio,
Right.
they're generally considered less volatile than equity-based ETFs, like those focused on stocks or real estate.
Oh, okay.
So this can be particularly appealing to investors seeking a consistent income stream and a buffer against market downturns.
So when the stock market is
Well,
having roller coaster day, bond ETFs are kind of
Yeah.
just chilling on the merry-go-round.
exactly.
They're just having a nice day.
Yeah.
All right. So the guide gives a few examples of bond ETFs, LQD,
Sure.
and Can
Okay.
you break those down for us?
Sure. So the iShares iBox investment grade corporate bond ETF, ticker symbol LQD,
LQD.
is a popular choice. It focuses on high-quality corporate bonds and offers a yield of around 4%.
Okay, LQD. For corporate bonds, what about BND?
So BND stands for the Vanguard Total Bond Market ETF, and it's known for its broad diversification across U.S. government on corporate bonds, and it offers a yield around 2.5%.
Okay, so that's bogey if you want. Like the entire bond market,
Yep.
all in one pack.
All in one packet.
All right. And GOVT.
And then finally, we have the iShares U.S. Treasury Bond ETF, ticker symbol GOVT,
Right.
as the name suggests. It holds U.S. Treasury bonds, which are considered among the safest investments in the world.
Safe. Probably not the most exciting. In terms of yield, though?
That's the trade-off. GOVT offers a lower yield, currently around 2%, but it provides that level of stability and security that can be invaluable during times of market uncertainty.
Okay, so we've got LQD for corporate bonds, BND for the broad market,
Right.
and GOVT for those seeking the ultimate safety net. Of U.S. Treasury bonds, it's starting to feel like building an ETF portfolio is like.
Assembling a superhero team.
I like that analogy. Each member with their own unique skills and strengths.
Absolutely. You've got your high-yield heroes, your steady and reliable sidekicks, and those with special powers to protect you during tough times.
I love it. And the key is finding the right combination of heroes to create a balanced team, which in this case is our portfolio.
Right.
That can achieve your specific mission, which is generating that $2,900 a month.
Exactly.
Feel
And
like
the guide goes even further. It actually offers a suggested portfolio strategy
Oh, that's
for
fun.
reaching that goal. It recommends allocating 40% to dividend ETFs,
Okay.
30% to REIT ETFs,
Right.
and 30% to bond ETFs.
Okay, so that's a pretty specific breakdown. What's the thinking behind those percentages?
So this mix aims to strike that crucial balance between risk and reward.
Right.
So the 40% allocation to dividend ETFs establishes a solid foundation of moderate yield and long-term stability.
So those are like the core of the team.
Yeah, the core.
Yeah,
Keep
exactly.
that steady.
Right.
And then the 30% allocated to REIT ETFs aims to boost the overall yield with those higher potential investments, but with moderate risk.
So the REITs are kind of like the growth-oriented heroes.
We are, yeah.
Okay.
Exactly.
But we're tempering that risk with that dose of the dividend stocks.
Exactly. And
right.
Finally, the 30% dedicated to bond ETFs acts as a stabilizer during market downturns, helping to preserve capital and maintain income consistency.
So those are the ones that are going to help us weather the storm
Yes.
when things get rough.
Exactly.
All right. I'm starting to see how the pieces fit together here. So you've got your diversified mix of the ETFs,
Right.
based on your risk tolerance, your income goals,
Right.
those percentages. Provide a framework for how to achieve that balance.
They do.
But I'm sensing there's more to the story,
Yeah.
especially when it comes to managing that portfolio over time.
Yeah, you're right on the money. Building the portfolio is just the first step. The real magic happens when you start implementing smart strategies to maximize returns and navigate that ever-changing market landscape.
Okay, let's dive into those strategies. I'm all ears.
Welcome back. So let's talk about those smart strategies that can help you maximize your ETF returns and accelerate your journey towards that $2,900 monthly income goal.
All right, let's hear them.
All right, so the guide mentions reinvesting dividends as a key tactic.
Okay, reinvesting dividends. What's so magical about that? Isn't it more satisfying to just pocket that cash?
Well, imagine this. You're a farmer planting seeds. Do you harvest every single sprout the moment it emerges from the soil?
No.
Of course not. You let those sprouts grow
And mature.
and produce even more seeds, leading to an abundant harvest down the line.
Okay, I see where you're going. Reinvesting dividends is like letting those sprouts grow.
Exactly. Instead of pocketing those dividend payouts, you use them to buy more shares of the same ETF. And this sets off a powerful chain reaction called compounding, which is essentially your money making more money, and then that money making even more money.
It's like a money-making machine that never sleeps.
It is.
So break it down for me. How does this compounding magic actually work with ETFs?
Let's say you invest $10,000 in a dividend ETF that yields 4%. That means you would receive $400 in dividends in the first year. Now, instead of spending that $400, you reinvest it, buying more shares of that same ETF. Now your investment is worth slightly more than $10,000. And those new shares also start generating dividends. So the next year, you'll receive slightly more than $400 in dividends, which you, again, reinvest, buying even more shares. This cycle repeats itself, with your dividends buying more shares, which generate more dividends, creating that snowball effect over time.
So it's like that snowball analogy. But instead of snow, we're accumulating dividends in shares.
Precise. And the longer you stay invested, the more pronounced this compounding effect becomes, leading to potentially exponential growth over the long term.
I am sold.
It's powerful stuff.
Reinvest those dividends.
Yes.
Let those money snowballs roll.
Let them roll.
Okay, so the guide also mentions dollar cost averaging as a smart strategy. Now, that one sounds a little bit more tactical, a little less magical.
It's a different kind of magic. It's a strategy designed to tame the unpredictable beast. That is the stock market.
Okay.
So with dollar cost averaging, you invest a fixed amount of money in your chosen ETFs at regular intervals, say monthly or quarterly, regardless of what the market is doing.
So instead of trying to time the market, you're just consistently investing no matter what those headlines are saying.
Exactly. Think of it like this. When the market is down, your fixed investment buys you more shares at a lower price. And when the market is up, you buy fewer shares, but at a higher price over time. This strategy averages out your purchase price, potentially reducing your overall cost basis and smoothing out those market fluctuations.
It's taking the emotion out of investing.
You are.
Yeah.
Exactly.
You're not reacting to every little market swing.
You're sticking to the plan, consistently building your position, regardless of the noise.
All right. I like that.
It's a strategy that embraces the long game, recognizing that the market is inherently unpredictable in the short term. But over the long term, it tends to trend upwards.
Yeah, historically, that's been true.
Right.
Okay, so we've got reinvesting dividends for compounding, dollar cost averaging, to kind of ride those waves of the market.
Those waves.
Yeah. Now, the guide also mentions lump sum investing.
Right.
When does that strategy come into play?
So lump sum investing is like making a bold move in a chess game. You're deploying a large sum of money all at once, hoping to capture a strategic advantage while it can really kickstart your portfolio growth. It's a tactic that requires careful consideration and a bit of market awareness.
So it's not just about having a chunk of cash ready to invest. It's about knowing when to deploy it.
Exactly. Timing is crucial. With lump sum investing, if you invest a lump sum, when the market is at a peak, you're buying high, potentially limiting your future returns.
Yeah.
However, if you can identify moments when the market has dipped significantly, a lump sum investment can allow you to buy a larger number of shares at a discounted price, potentially supercharging your long-term gains.
Okay, so it's more about seizing those opportunities when they arise, not just blindly throwing money at the market.
That's the key. It's a strategy that requires a bit more finesse and a willingness to ride out those market fluctuations.
Okay, so seeing these different kind of investing approaches here.
Right.
We've got reinvesting dividends for that steady growth.
Long-term growth.
Yeah. Dollar cost averaging. Yeah. For that disciplined approach.
Emotion-free autopilot.
Yeah. And then lump sum.
Yeah.
As the stars align.
Yeah.
And you see that opportunity.
Exactly.
Right.
Each strategy has its place in a well-rounded investment plan.
Yeah.
And the guide really emphasizes it's about finding that right balance and tailoring your approach to your individual circumstances.
Right. Now, speaking of individual circumstances, we can't forget about the realities of investing, the things that can chip away at our returns, fees and taxes.
Yeah, nobody likes those.
Nobody likes to see their hard-earned gains just disappear.
Okay.
So what does the guide recommend for minimizing those costs?
So when it comes to ETFs, one of the biggest cost factors is the expense ratio, which is an annual fee charged by the ETF provider to cover administrative and management expenses. Yeah. Now even, seemingly small differences in expense ratios can compound over time, impacting your overall returns.
It's like those little drips of water that slowly erode a stone over time.
Exactly.
Okay.
They may seem insignificant at first, but they can really add up.
Especially when we're trying to hit a very specific target.
Right.
Like $2,900 a month.
Right. Exactly. And the guide highlights a really key point here. Actively managed ETFs, those with portfolio managers, making investment decisions typically come with higher expense ratios than passively managed ETFs, which simply track a specific index or market segment.
Okay, so if we're going for low fees, passively managed is probably the way to go.
Generally, yes.
Okay.
Passively managed ETFs often boast lower expense ratios because they don't have the overhead associated with active portfolio management.
Okay, so we're on the lookout for low cost, passively managed ETFs.
Yes.
Now, the guide also mentions Vanguard and Schwab as examples of providers that are known for those low fee options.
They are. They are. Both companies are renowned for their commitment to low costs, making them a really popular choice among cost-conscious investors.
All right, so Vanguard and Schwab noted. Now, let's talk about the tax side of the equation and any tips for minimizing that tax bite on those ETF earnings.
So the guide offers some great advice here. First, consider holding your investments for the long term.
Okay.
In many countries, if you hold investments for more than a year, you qualify for a lower capital gains tax rate when you eventually sell. Those investments, so if you're not planning to trade your ETFs frequently, holding them for the long haul can be a tax-savvy move.
It's like a reward for patience.
It is. Yeah. It is. The guide also suggests exploring tax-advantaged accounts like individual retirement accounts, IRAs in the U.S., or individual savings accounts, ISAs in the U.K., to hold your income-generating ETFs.
Okay, so tax-advantaged accounts, what makes them so special?
So these accounts offer various tax benefits, depending on the specific type. And your country's regulations, some allow you to deduct your contributions from your taxable income, reducing your tax burden. In the present, others allow your investments to grow tax-free, meaning you won't owe taxes on those gains until you withdraw them, potentially decades down the line.
So it's just giving your investments a tax haven.
It is.
Yeah.
It is. Right. Of course. There are rules and limitations associated with these accounts, so it's always best to consult with a financial advisor to determine the best approach for your individual situation.
Okay. Never hurts to get some expert advice. All right, so we've covered a lot of ground here. on maximizing returns,
Oh,
minimizing costs. I feel like we're assembling an elite team of ETFs,
armed with.
smart strategies,
Yeah.
and tax-saving shields.
You're getting the hang of it.
But we can't forget about the other side of this
Right.
risk.
The ever-present shadow lurking
Yeah.
behind every investment decision.
So let's not sugarcoat it. No investment is without risk.
Absolutely. And the guide does a great job of laying out those potential downsides, reminding us that relying solely on ETFs for income is not without its vulnerabilities,
Right.
one of the most significant risks,
Yep.
market volatility.
Okay, so market volatility we're talking about. Those unpredictable ups and downs
Right.
that can send our portfolios on a roller coaster ride. So how does that specifically impact EPFs,
Yeah.
especially the ones we're looking at, for generating income?
Imagine you've built this beautiful portfolio of dividend-paying ETFs, REIT ETFs, and bond ETFs, all humming along, generating that consistent income stream. And then the market takes a tumble.
Oh, no.
Suddenly those share prices drop and those dividends, once so reliable, start to shrink. Or worse, disappear altogether.
That is a scary thought.
It is a risk.
So even with us, a well-diversified portfolio, those market swings can really impact that income stream.
That's the reality of investing. You can diversify. You can choose solid companies. You can implement smart strategies. But you can't completely eliminate the risk of market downturns.
Right, so it's not about pretending that risk doesn't exist. It's about
Yeah.
understanding it
Yeah.
and taking steps to...
Like mitigate it.
Exactly.
Right.
So what other risks does the guide highlight?
Another key risk, especially for those relying on bond ETFs, for a portion of their income is interest rate fluctuations.
Okay, so
Interest
Like-
rates, little numbers that
Yeah.
seem to have a big impact on everything.
yeah, from mortgages to credit card payments.
Exactly.
How do those mess with our bond ETFs?
So bond prices and interest rates have this interesting relationship. They move in opposite directions.
Oh, okay.
So when interest rates rise, bond prices tend to fall. And conversely, when interest rates decline, bond prices generally rise.
Okay, so if interest rates decide to climb, our bond ETFs...
Could take a hit.
Exactly.
Yeah.
And if you're relying on those bond ETFs for a steady stream of income, that
Yeah.
income could shrink as those bond prices decline.
Got it. So that's another thing to keep on the radar.
It is.
Interest rate fluctuations.
It is.
Okay. Any other risks that the guide warns us about?
So the guide makes another really important point that I think sometimes gets overlooked in the excitement of
Right.
building this passive income portfolio.
Okay.
It stresses the importance of having backup income options.
Backup income options.
Oh,
Okay.
okay.
So like a side hustle or a rainy day fund.
Exactly.
Why are those so crucial when we're already, focused on building this ETF income stream? Imagine this. You've meticulously crafted your ETF portfolio. You're hitting that $2,900 a month target, like clockwork. And then life throws you a curveball.
Yeah, it happens.
Yeah.
Unexpected things happen.
You lose your job. You face unexpected medical expenses you decide to pursue. A passion project that requires a temporary dip in income. Suddenly, that ETF income, once so reliable, isn't enough to cover your needs.
Okay, yeah, it's like having a safety net.
It is. It is. It's
Fascinating.
about diversifying, not just your investments, but your income sources as well.
Yeah.
So the guide suggests exploring high-yield savings accounts or even considering part-time work as ways to supplement your ETF income if needed.
Okay, so diversifying investments, diversifying income streams, and acknowledging those risks. We're building this ETF income machine,
We are.
but we're also making sure we've got a backup plan.
Absolutely. It's about being prepared, not letting those risks paralyze us, but rather informing our decisions and building a financial plan that can withstand life's inevitable storms.
All right, so that was a whirlwind tour of ETF strategies, risks, and safeguards.
It was.
I think we've given our listener a lot of information to digest, but I'm sensing we're not quite done yet.
We're not.
We'll be right back. To wrap things up, all right, we've covered a lot in our quest to figure out if you can really generate $2,900 a month passively using ETFs. I feel like we're ready to bring it all together, see what kind of picture emerges.
Yeah, let's synthesize all those details, connect the dots back to that $2,900 goal.
So we started by establishing that ETFs can be a great tool for this. They offer diversification to spread risk, low fees to maximize returns, and liquidity to give us options.
Right. And remember those calculations we did? The amount you need to invest to hit that $2,900 a month really depends on the yield.
Yeah, those numbers were interesting. 4% yield, we're looking at around $870,000. 5% gets us down to $696,000. And at 7%, it's $497,143. Big difference. But of course, higher yields often come with higher risks.
That's the balance, right? Risk versus reward. And that's why the guide suggests building a balanced portfolio. 40% dividend ETFs, 30% REIT ETFs, 30% bond ETFs.
Right, so you've got solid companies paying those dividends, real estate for potential growth, and bonds for stability. But it's not just about setting it and forgetting it.
No, not at all. Managing the portfolio over time is key. Rebalancing to maintain those percentages, making sure it stays aligned with your goals.
Right, and those smart strategies. Reinvesting dividends for that compounding effect.
That's a powerful one.
Dollar cost averaging to navigate the market. Lump sum investing when the opportunity is right. And of course, we have to be mindful of fees and taxes.
Absolutely. Choosing low-cost, passively managed ETFs, exploring tax-advantaged accounts.
All about maximizing those returns. But let's be real, no investment is without risk.
Right.
Market volatility can impact returns. Interest rates can affect bond ETFs.
And that's why it's crucial to have those backup income options.
Like a safety net,
Yeah,
just in case.
exactly.
So what does all this mean for our listener?
Yeah.
Who wants to generate $2,900 a month passively using ETFs?
It means they have the knowledge now. They understand ETFs, the different types, the strategies, the risks, the safeguard.
They've got the blueprint, the
Yeah.
tools,
Yeah.
the mindset. Now, the real question is, what are you going to do with it?
That's the challenge.
You've seen what it takes. Now it's time to take action.
Start small if you need to. Keep learning. Keep investing. Financial independence is a journey.
That's a great way to put it. Thanks for diving deep with us into the world of ETFs and passive income. We're excited to see what you achieve. Until next time, happy investing.